Hi, and welcome to one of our videos here where we'll take a closer look at the shipping sector. A few weeks ago, we took a closer look at the car carrier industry, and this time we'll dig more into the product tankers. My name is Rasmus Køjborg, and I'm joined here today by Philip Coombs. We are both equity analysts here at HC Andersen Capital, and Philip has done some research on this shipping segment lately. So very welcome to you, Philip.
Thank you, Rasmus.
And let me first draw your attention to this first slide with our disclaimer. It's important to say that neither Philip or I own any shares in the companies that we mention in today's video, and that HC Andersen Capital has digital IR agreements with Hafnia, Norden, and Torm. First of all, Philip, could you give us a little bit flavor on what a product tanker is?
Yeah, sure. So product tankers are a subsegment of the larger oil tanker sector, and they carry refined products. So they carry things like diesel and jet fuel and then take them from refineries to their end user markets.
And there's also, sometimes I've seen mentioned that there's also clean oil products. So that is sort of like the diesel and the gasoline. And you also have dirty oil products, and that is sort of the heavy fuel oil, as I understand it, or the bulk you have for different kind of engines, for ship engines and things.
Exactly, and the product tankers are then in the clean refined oil product sector.
Yeah, and what are they called, these different ship types in the product tanker segment?
Yeah, so they have different sizes. The largest ones are LR2, standing for long range 2, LR1, long range 1, MR, medium range, and then Handy is the smallest size.
All right, and they are sort of compared to the crude tanker industry. It's VLCC, Suezmax, and Aframax. Is that correct?
Yeah, and they're somewhat smaller than the crude tankers. The LR2s are about comparable with the Aframax of the larger crude tankers. The smaller end of the crude tanker is about the top end of the product tanker.
Okay, very good. But also, Philip, it seems like Maersk caught some headlines last week with some negative market conditions. But it also seems like that some of the product tanker companies actually reported quite strong. How is that?
Yeah, exactly. So last week, Maersk was in the headlines, and especially around the Red Sea conflict, the container shipping companies had seen a bit of a rally after this Red Sea conflict. Means they had to divert and take long distances around the Red Sea. And the CEO was out on the earnings call and disappointed the market, saying that actually this Red Sea situation is going to be temporary for containers, and there's an unfavorable supply and demand outlook in that sector, and that sent the shares down and made lots of news headlines. So the video today is really looking into the product tanker market and how the supply and demand conditions are very different here compared to in the container market.
Very good. And sort of looking at some of the shares in this segment, how have they performed in recent years?
Yeah, so I mean, the product tanker segment has really been a top performing area over the last few years, and we see here the 2-year return graph where we have Tom with over 500% total return, so that's including dividends, Hafnia 470%, and Scorpio 360%. And even year to date, the product tankers have, on average, they're up around 13% year to date. So they're continuing their march higher, at least so far this year.
And what has sort of, from your view, been the reason behind this strong performance?
So it's a great question, and it comes into this supply and demand situation. So they first caught the headlines under COVID-19 when the OPEC, Russia and Saudi situation led to a large demand for floating storage. So we can see that there was a spike here in 2020. And then since then, we've had the Russian invasion of Ukraine, and that's really changed the oil flows. So previously, Europe would get many of their refined oil products from Russia, and that situation has now changed. And that adjustment in the market has decreased the supply as ships have had to travel further distances and held a much higher rate level since then. So that's really been the story so far, and throughout 2023 those rates stayed high. And then now into 2024 we've had the conflict in the Red Sea, which has again led to even further ton miles where these product tankers are having to take longer journeys to get the oil products to their end markets.
Yeah, we've really seen this Red Sea conflict taking some headlines in this industry. But why is it such a big issue? You know, can't you just choose another route if you can't go through the Red Sea and the Suez Canal?
Well, exactly. So if we look at the graphics here that were shown from Scorpio Tankers' recent Q4 presentation, we can really see the effect that the Red Sea conflict has had. So on the left-hand side, we see the standard routes through, from East Asia to Europe, from the Middle East to East Asia, the Mediterranean to East Asia, and the Middle East Gulf to Europe. And all of those routes would typically use the Suez Canal, but they're now having to take a large diversion all the way around the Cape of Good Hope and Africa to get to the same places. So this is locking up supply in the process, and the graph on the right hand side really shows the extent to which this avoidance of the Red Sea has taken place, and volumes have fallen by over 50% according to this graph.
Okay, very good. But Philip, sort of looking at most industries, if you have a demand that is still fairly strong, as we'll see in a couple of slides, and you also have a supply that is somewhat disrupted because of this conflict in the Red Sea and the thing that you have to go all the way down south of Africa. Why don't you just add some more capacity, build some more ships, or even go faster with the ships you already have?
Yeah, it's a good question, and especially within the shipping world, it's historically been the case that once you see good rates, there's been a big influx of ordering of new vessels, and that's quite quickly brought rates back down, and that's what we've seen in the container market, for example. But the situation actually looks quite different in the product tanker market. And if we look at the graph on the left-hand side, it shows the historical order book, and the last boom was there sort of around 2006 to 2008, and we can see this large influx of new orders, and that actually hasn't happened this time around. And there's a few reasons for that. One of them is the future demand of oil. There's a lot of talk about the green transition and then ordering an asset that needs to last for 20 to 25 years. There's uncertainty around that. There's also uncertainty around the future availability of green fuels. So there's environmental regulations coming in, and a lot of the new vessels are then dual powered, but whether there'll be methanol or LNG to power these vessels in the future, again 20 to 35 years, is still uncertain. So these things are holding back the incentive to order new vessels. But we can also see, if we look at the right-hand side, the fleet is starting to reach a point where existing vessels are needing to be changed out and reaching that retirement age of over 20 years. So those vessels that came into the market in that sort of 2008 time period are nearing the point where they will then be looking towards being scrapped. So even if we get some new orders, the market will need that replacement by the time 2029 and 2035 comes around.
Yeah, I think we have that also on the next slide where we can see that, where it's looking into sort of the LR2 and the Aframax and sort of the capacity that is getting quite old, that is above 20 years.
Yeah. And this slide that we have here shows where the order book is at the moment. So the first one on the left shows that the new vessel supply has really been low, so only about 2% per year since 2021, and that the order book actually is looking low. So the total product tanker order book is around 11%, but there's also estimated scrapping coming into the market. So we see that the graph on the bottom right shows that the net fleet growth is going to be sort of hovering around that 2 to 3% for 2025 and 2026. So really low levels, especially if we compare that to demand, which we can show later on.
Very good. And also, who is taking up all this yard capacity? I know you've been looking into that also.
Yeah, exactly. So that's actually another story, that the shipyards are full until about 2027. So even if the product tankers want to order new ships, they won't be able to get them delivered until around 2027 or beyond. And that's because the yards are full, and a lot of this has been containers and LNGs. And if we look at the container market to compare, we can see the container order book is sort of around the 30% level, and the actual delivery schedule is heavily weighted towards 2024 and 2025. And it really shows the difference in the supply conditions for the product tankers compared to the container markets.
Yeah, and I think you also mentioned the LNG, and I think what we're seeing in the numbers there, we don't have it on the graph here, but I guess that order book is quite massive, and I guess it's also related to sort of the war in Ukraine, and also the ban on Russian gas. So now you'll have to transport the LNGs more by ship than by pipelines, if you've done previously.
Exactly, and yeah, the main story is then that the shipyard capacity is full, and that these product tanker new orders are restrained until at least 2027.
Very good. As we just briefly touched upon before on the demand side, is still looking quite strong on oil.
Yeah, so especially in refined oil products, and part of that story over the last few years has been the sanctions on Russia, and that's changed the routes that countries get their refined oil products from. So that's added some extra ton miles to the market, as we can see on the left-hand side. But the other story has been this refinery dislocation, that many refineries in Europe are closing down, and they're being replaced by refineries in Asia and the Middle East. And just as a result of these things, the standard routes for product tankers are changing, and they're on average going to be traveling larger distances. So that's also supporting the demand side. And then if we look at the graph on the right, we can see that's where the difference between refined product exports and ton mile demand is coming from, that these larger routes are supporting demand on an ongoing basis. And we can also see that the expected demand is going to outpace the expected supply growth, at least for the next 2 years on this graph.
And as you showed us in the beginning, performance for some of these shares in the industry has been very, very strong. So one would probably think that, valuation ought to be quite stressed now. But is that the case, looking at sort of the multiples in the market?
Yeah, it's definitely the first thought when you see share price reactions like we've had. And if we look at this peer group table, which we have, we can see that on an EV/EBITDA basis, we have around 5 to 6 times, and price earnings around 6 to 7 times. And if you compare that to the general market, for example, the S&P is trading on average PE of around 20 times. So it's much lower. I'm not saying that the product tankers should trade there, but in general, if you think that the earnings levels that they've seen in 2023 are going to be maintained for a long time period, they could feasibly justify a higher earnings multiple than this sort of 6-7 area that they're at.
Yeah, I guess sort of a potential investor in these shares, or a current investor, should sort of make up their own mind whether how or for how long they think that this sort of extraordinary earnings period can consist. I guess that's sort of the main question. And as we look into it right now, it doesn't seem like there'll be a lot of capacity coming to the market for the coming years, or not something that the market cannot absorb. And looking at sort of the projections that we have here on the analyst estimates from Refinitiv, it seems like dividend yield will be quite attractive for a number of years. if we sort of look more into it, it seems like Scorpio Tankers is not paying that higher of a dividend. You got an explanation for that, Philip?
Yeah, Scorpio Tankers in particular, they prefer share buybacks, so they have a small dividend, but are primarily returning capital to shareholders through share buybacks. But yeah, I think if we look at the dividend yield estimates for 2024 and 25, it's because the analysts are expecting a similar earnings strength for 24 and 25, and that's sort of supporting this ongoing shareholder returns. And then the question comes, after that, how long are the earnings going to stay strong? But if that strong earnings level is continuing for many years, then that supports the valuation basis. But if we look at Hafnia and Tom, for example, their dividend yields, who primarily pay dividends rather than buybacks, are up over 10%.
Very good. And sort of if we should just conclude by looking at sort of the bull and bear case as you see them right now, could you just run through them for us, Philip, please?
Sure. And I think, as we've discussed, the bull case is primarily based on this supply and demand conditions that we have that can create an outlook for strong rates in the product tanker market for many years. And if that actually does play out, then potentially there's some multiple revaluation, and the shareholders will also see a strong return to shareholders through buybacks and dividends during that period, which can support the bull case. The bear case is then based on if we do start to see a massive influx of new orders, and they start arriving sort of 27, 28, maybe that long-term picture is less certain. And with product tankers and shipping generally, at the moment, there's a geopolitical lens to it. So if there was a ceasefire or the conflict in the Red Sea ends, for example, we'd expect there to be a negative impact on rates. And if there was a resolution with Russia and Ukraine as well, you would probably see some normalization of trade routes. Probably wouldn't go back to exactly where it was before, but would return to a more normalized level. So I think there's a definite uncertainty as to the future, but there'd be my views on the bull and bear case.
And I also think, at least from sort of looking at this industry in a historical perspective, as sort of with the experience I have from this industry, is that it can be very volatile, and it can be a very good case for a number of years, and it can also be a very bad case for a number of years. It has quite a good level of cyclicality. That's at least how it has been historically. We can't say that that's how it's going to be in the future, but that's how it's been historically, that when new capacity hits the market, we'll probably see that rates will come down at some point. And then, as we said before, one has to make up one's own mind when that will be, that sort of the capacity will come to the market. And as it looks now, it can be like this for a number of years before it really hits in. But I think we'll conclude with that. Philip, thank you very much for giving us this detailed rundown of the product tanker segment.
That's great. Thank you, Rasmus.
Yes, and thank you very much for those of you who listened in. Thank you very much.